Okay, so here we go. Monday, like every Monday, we are with the lessons of the book, Price Action for All. This is the Spanish book, but of course we got the translation on the website so you can get it. And it talks about everything about price action, the theory, the strategy, people points, how to identify buy prices and sell prices, market areas, macroeconomic information, how to trade high impact information, and all of that. This is going to be only English, okay? The Spanish lessons is on Wednesday, and we do it with the YouTube format, and the English ones is actually on Mondays, and we do it only English, of course, with no translation. All right. So the other lessons, the other classes, we do have a playlist on our YouTube channel, so you can get access to it and you can, study from those lessons. So basically the idea is to study from the book and to give notes of every single topic, because I understand sometimes that if you're coming from different trading methods and, chartism, indicators, it might be a little bit complicated to get into price action. So that's the idea, and that's why I'm offering the author's help, so it's much easier for you to actually study price action. Okay, so the first lessons, like I said, is already on the YouTube channel. So when you get the book, you won't see as many charts. There's not that many charts. It's actually the explanation of everything. Like I said, the idea is to go through from the most general topics to the more specific ones, and finally to get to understand price action with any instrument you want to apply. If you want to use stocks, if you want to use cryptocurrency, if you want to use it with FX and everything. It's better used in the FX market, yes. It's better used in the FX market. FX market, as we all know, is the biggest market worldwide. It's $5 billion compared to that amount of daily volume that the stock market offered us. And cryptocurrency is not even close. It's not even close. So that's why price action is better used with high volume instruments, and FX today, and it's going to be forever like that, is the highest and most impressive market worldwide. So my recommendation, of course, is to go with FX market using price action. So the first topics we talked about trend, which we don't use the term trend in price action, we use market area. So always the market is divided in buy market area and sell market area. So the first thing first, you need to understand if you are trading in buy pressure or sell pressure. Every instrument is always exchanging buy levels or buy prices and sell prices in different market areas. So that's the first thing. You have to understand what market area you are involved. Another question is the market area changing through the year? Or once it's in the buy market area, it's going to stick to buy market area the entire year? So that's a good question you should ask yourself. If you are trading the euro, dollar, the dollar, yen, gold, silver, or even whatever instrument, the question is, it's always going to be in buy level or in sell level? There's always an answer, and the answer is that it shouldn't change the market area. It shouldn't change the market levels. It should be always in buy pressure or always in sell pressure. And when you know that is in the month of March. We all know that March is the month that we know when the market is going to move, if it's going to move into buy pressure area or it's going to move in sell pressure area. Okay, so there's always parameters that we all know. Every time we have a democratic administration in the US, typically we have the dollar down. Okay, typically we have a bearish dollar when we have a democratic administration. Republicans, they take the dollar up. Okay, so that's when we kind of know if we got elections, for example, if the dollar is going to go up or down depending on who wins on that specific election. So that's one of the I'm going to say parameters that you can take to know if the dollar is going to go up or the dollar is going to go down. So if you have a Republican Party in the US, the dollar is going to go up, and if we have a Democratic Party, the dollar is going to go down. That being said, everything related with the dollar this year, it was of course into the downside of the market, and therefore the euro was up, the pound goes up, the Australian goes up. So that's the main situation that we are at this point. Of course, many things changed since the pandemic year up to now, like the stimulus plans, the rates of every country. Many things been changing, since last year and up to now. So that's kind of the situation that we are involved at this point. Now, if I had to look forward, if I had to see, okay, what's going to happen next? So pandemia, okay, lockdowns, fine, economy stuck, whatever. So now what will be the next steps now? So now we have the vaccination process. Now we have, economies trying to recover the employment, inflation trying to get stable. I'm not going to say lower, I'm going to say stable. So those kind of things that are kind of making the economy to think that probably is the moment to start increasing the rates. So the rate of the cut rates, I'm going to say is pretty much done. I'm not going to say it's over. I'm going to say that it's pretty much done. Like, they shouldn't be cutting rates anymore, but they could. But if they've done it, if they haven't done it up to now, which we're starting the second semester, then means that probably they're not going to do it for the entire year. They're going to start measuring the indicators, inflation, employment, everything. They're going to start measuring the numbers, so they might do something within next year, but not this year. So basically, most changes and the most important decisions in the market are made in March. So we can say March is going to be a downside for the dollar, or it's going to be an upside for the dollar. So of course we are in the downside of the dollar. Many things happened, yes. So now we are in the process where all the central banks in all the different economies are kind of considering to probably is the moment to increase the interest rates. We have Australia tonight. Australia is going to announce the rates tonight. So tonight is a good moment to do something with the Australian dollar. I don't think they're going to increase the rate, but maybe they're going to announce it. They're going to announce that probably they're going to be increasing the rates. And that, to the market, is the same thing. If they say that they're going to do it, for the market, it's the same that if already happened. So probably we're going to buy the Australian dollar tonight. It's going to happen at 1:30 a.m. Eastern Time, rate of Australia. And then we have rate of the FOMC on Wednesday. So Wednesday, the FOMC, the Federal Reserve rate for the United States. They're not going to increase the rate. They're not going to cut it, but probably they're going to say something about it. They had to mention that what they're going to do next, the next steps, because that gives confidence to the markets, to the economy. What are they going to say? I don't know. We have to wait until Wednesday and see what's going to happen. But the dollar is down. In all the currencies, all the cross pairs, we have a downside on the dollar. Okay. So that being said, again, this material is going to be here on the Instagram, but as always, we do it here as a Zoom meeting. Okay. So now let's go to our thing today. All right. So we talk about map price. We talk about market prices and closing prices, how the market opens, how the market closes. All of that is done. And I would like to go with price identification, how you know when it's a buy price, how you know when it's a sell price. And here, many people tend to get confused when they recognize buy prices and sell prices, that actually you can buy when the market touches a buy price, or when the market opens into buyer, and you can just right away buy. And the opposite, many people actually sell when the market opens. For seller, they right away sell, or when the market touches the sell price, they right away tend to sell. And it's actually not the ideal situation, right? It's not an ideal situation just to jump in the market when you see a buy price or a sell price. So the answer to that, when do you know when the market is into buy levels or buy prices and sell prices? You have to remember that we talk about levels. We talk about levels. It's not just one price. Yeah, go ahead.
Please, I noticed you're not recording this on Zoom. Since you started, it's not yet being recorded. Can you check?
It's not still. Oh. No, it's not being recorded here, but you know what, Sam? I have it on the Instagram. So we have the recording done on Instagram. So I'm gonna ask to Caro to send you that recording, okay? So you because I never use Instagram for this. There's not people actually connected there. But the recording, we're gonna leave it here instead of Zoom, because the problem is that I got names and it's just and the chat. So I'd rather just keep it clean on the Instagram. But we're gonna send it to you. So,
all right, that's good. Thank you.
Sure. So the idea here basically is we talk about levels. So I've seen many traders trying to jump in the market whenever you identify a buy price and a sell price, and they get then kind of desperate because the market turns around within the next few minutes. Well, rule number one, you have to be really patient working with price action. Really patient working with price action. Rule number two, whenever we have psychological levels, meaning the round prices, the 119 on the euro dollar, the 120, the 121, the 122, and also the 50, the 119.50, the 118.50, the 117.50, the 50 round numbers, always wait the confirmation when you see psychological prices. When you move around within the market range, of the market, and you take the different intervals of the market within the range, you're gonna be safe, you're gonna do good, it's no problem. The problem is on the extremes of the full market range. The problem is on the extremes of the full market range. And that means the 119 is a problem, the 119.50 is a problem, the 120 is a problem, the 120.50 is a problem. It's a problem when you are studying the price action and you kind of jump in the market because you see a buy price or a sell price. It's not a problem when you already got the practice and the psychology to wait enough time, enough confirmations to jump in the market. Okay, so let's give a practical example here. So we are now with the euro dollar for the example. Well, the euro dollar, you have to first identify the range of the market that you are getting involved. We are trading at the 118.50 and 119. We're not at 117, we're not at 119 and 118. We are now again at 118.50 towards the 119. 118.50 towards the 119. Okay? So once you identify that, it's much easier then to plan every strategy that you want, because you know what level you can jump in the market. So now we are actually trading inside the market range, which is the perfect situation. Inside the market range. You're safe, easier, everything good, no problem. Every single trader gets stuck on the extremes of the market range. Inside the range, you're gonna have different intervals. That's why we scalp the market inside the market range. So we take every single step until the market range is completed. That's what we do. That means scalping. That means we take every single opportunity we can within the market full range. Okay. Another thing is, of course, we don't use the stop loss. The stop loss is now for price action. That's a beginner's sort of technique. Whenever we take a loss, it's because the market is going to give us the expiration of the price. Let's give a practical example here. Okay, so we said euro dollar. We are above the 118.50 up to 119. That's the full market range. Inside the market range, you're gonna have 118.60, 118.70, 118.80, 118.90, and finally the 119, right? Are you following me here?
Yeah.
Great. So it means that when you are inside the market range, completely free from the extremes, of the market range, you're inside of it, you're already doing your job, taking all the intervals, you're gonna do fine. You're gonna do perfectly fine, there's no problem. Whenever you jump in the market, yes, it's gonna try to drop a little bit, because remember, for every buyer in the market, there is a seller, and for every seller, there is a buyer. And that is called also market liquidity. That what brings a lot of market here in a lot of traders here in the market, because of the liquidity that provides liquidity. If there's not such a thing, the market will be very stable. It will be only buyers one day, or be only sellers one day. It's not the case, and that's good. So that being said, whenever we jump in the market, it's going to try to drop a little bit, and that's why we cannot use a stop loss, because the stop loss, it will get activated no matter what. The question is, well, how you do it then? Well, one more time, inside the market range, when you're safe inside the market range, no problem. That's when you have to be patient and wait for the prices and everything. My suggestion always is, when we trade at the extreme of the full market range, at the extremes, 118.50, 119, we typically should expire the trade whenever we see that it's losing the confirmation or is pulling back to the entry price that we got. That's a very important golden rule right there. Whenever we are trading at the extremes of the market range that we are trading with, I'm gonna give another examples, but because I'm watching the euro right now. Inside the market range, no problem. You can buy any buy price, and you get the target, no problem. If we are trading at, for example, buying at the 118.50, because we're looking for the target 118.60 or 118.70, but then the market is losing power, it's losing reaction. If within the first time frame of 15 minutes, the market is not giving you the confirmation and is not keeping the order positive, or is not keeping the price at the 118.50, you must close the trade, and you wait for another confirmation, and you wait and you do another entry. You close that one, okay? Because again, that's the buy price. You waited for the confirmation, it gave you the confirmation, but then it lost the confirmation. So there's no point of keeping a trade that you know it might lose power, and then what's going to happen next? It's going to go down, it's going to drop, right? And what if it drops? Well, if it drops, what's going to happen is that instead of going from 118.50 towards the 119, it's going to go from 118.50 down to 118. You see? So very important, keep your strategy within the market range, and be careful with the extremes of the market interval that you're trading with. That's gonna get you in trouble. How you do it? Do you use a stop loss? No, you cancel whenever you see the market dropping from your entry price, whenever the market is losing the confirmation, whenever the market is showing you, you know what, we're not buying at the 118.50, we're not buying at the 119 anymore, so what are you doing here? So always ask yourself, what levels am I trading at this point? Are you inside the market range, you waited for enough confirmation, or you're trading at the extremes of the market range? At this point, we are fine with the euro dollar, we are inside the market range into the buyers, yes. We shouldn't have any problem with the euro going up. We're holding buy transactions on the euro, yes. Let's go to the pound dollar. Same for the pound dollar. If you see the price on the pound dollar, what do we see now is the 138.50 level. Is that good enough to go for the buyer? Yeah, and the reason is because we are above the 138.50. So it's gonna take us towards the 139. It means we are actually at the very beginning of the buyers in the market that's going to take the pound towards the 139. We are at the very beginning, and that is a kind of tricky situation. So on the pound dollar, we are not buying here, we're buying at the next market level, the next market buy price, which is the 138.60. You see the difference? One buy price, when the market is inside the market range, it can absolutely show you buyer. But also, if it loses the confirmation, if it loses buy power, it's gonna take you down again. It's gonna take you down again. So do not assume that because the market is inside a buy price, is inside a buy market interval, it is gonna go up. That is an assumption. It's not a rule. It's gonna go up unless it shows the opposite. Unless the market is telling you, you know what, we're not buying here anymore. So what you do, you close the trade. You don't wait for 15 minutes or no, you close it, right? Let's give another example here. Let's go for the dollar Canadian, which is the opposite. So now, dollar Canadian, we are at this point below the 123.50. That means it's gonna take us down to 123. That's the full market range, the market range. Below 23.50, going down to 123. Again, if we sell below 23.50 but it's not showing sellers and it keeps pulling up, you close the trade because it's going to get higher. The strategy on the dollar Canadian is a sell strategy. We on sell pressure area. The strategy on the euro and the pound is in buy pressure area. So everything we do on the dollar Canadian, we're better off keeping into the seller, right? Now, we keep it into the sellers, but again, whenever we got a sale day like today, fine if we sell. But whenever it touches the sale price but pulls back, the buyer tries to push the price, you cancel the trade and you trade higher, you sell higher. But we're not changing market areas on the dollar Canadian. We keep it on the sell, we keep it on the short. Okay? And so on.
Okay.
So on. You see, all the levels that we're talking about here is the same. Now, whenever we apply the pivot point, which is going to be on the next Monday, we're going to talk exclusively on pivot points. Then why am I doing the opposite? Why not just start with pivot points and then go to this information on price action? Because the idea finally is that you get totally free from the chart. You need to be free from the chart. You have to be totally out of the chart. If you don't see the chart and you see only the numbers, only the prices, you should be able to visualize in your mind what the strategy is going to be and what levels you're going to use and everything. And that's the idea. So if you exercise your vision and saying, okay, I'm not going to use the chart, I'm going to write down the prices, at the end you're going to be more effective and more emotionally controlled on every trade you do. If you learn pivot points before and you know the rules of the pivot points and you say, oh yeah, if it closed above the pivot point, I'm going to buy, and then it's not going up anymore, but you didn't know about the rules of price action, most likely you're going to end up losing. And that's the problem. Every person, every trader, that they want to get good at indicators, but indicators, guess what? It's not going to take you anywhere. Indicators is just an algorithm that it puts together numbers and it's showing you some sort of a pattern. And we love patterns. We seek patterns every time. We try to seek patterns on everything. Patterns are not going to save you from a reversal of the market, from a crisis in the market, because you're going to have that also. And you must be able to defend yourself from those moments. Because the pattern, if something happens outside in the market, guess what? It can crash everything. So you must be able to defend yourself from those moments. The algorithm is just going to get all confused. It's not going to show you any information that you must know in order to have your plan B. And so you can short fast enough, you can buy fast enough. If you're selling, you can, you know all those things. This is not just jump in the market and close it. Is no. Things are going to happen, and when they happen, you must be able to actually react as fast as possible. Indicators are good up to a certain point. So that's the reason why I rather first start with prices, how you identify prices, how you be safe trading prices, and then we go from the pivot point. So you kind of know, okay, well then, okay, this is the information that I need to know about the pivots. But it's something that is going to be there, widening your perspective, if you want to call it like that. But it's not going to set up anything for you. It will not think for you. You have to do the thinking. You must do the thinking yourself. Otherwise, we all be machines. I'll be just putting an automatic trading system here and fuck it. Trust me, I tried them many years ago. It worked well until something happened in the market, and the automatic thingy was like, oh, I did not see that coming. I'm sorry, and then you just lost it all. It's just robots, Okay, I want to relax this month, and then you put on automatic system to trade for you. Guess what? It did not last 2 weeks. So anyway. But again, I think you are the only person that can actually know the limits of the risk with your money, with your investments and everything. Don't trust your money or anything to anyone, not even automatic system. That's why they'll sell you the automatic system to begin with. That's why there's a huge market about it. That, oh yeah, this is the 100% profit system that never fails and blah blah. You can pay a lot of money for those. It's not gonna work. It's not gonna work. It cannot do the thinking job that you have. That's why there's people on all the trading floors and hedge funds and stuff. There's no systems. They might use a system to kind of, help to the analysis, but they don't use that to trade. They don't use that to trade. On top of that, if there is high impact information that day, the automatic system, you're also going to get confused because it's going to be a lot of volatility, and systems will not read volatility. You get confused. Okay, so
that's true.
About the market, buy levels and sell level. This is very important too. So the question typically is this: how you know there is a buy level, how you know it's a sell level. Remember that the market is shaped by people, by traders, right? And there's also always a psychology involved on every level and every price. Always there's a psychology involved on every level and every price. And that's the reason why the 119 on the euro dollar is been always acting as the take profit level. Above the 119 is been acting like buy situation, buy levels, buy prices. Every level always acts accordingly to the psychological situation, the psychology of the market on that specific level. And that repeatedly over time, it gives you enough information, an accumulation of information, so you know that whenever you are at the 119, the 118, the 117, then yes, you can jump in and buy, or you have to take your profits out of the market. There's no other reason. There's always and only the psychology, right? So even if you are 2021, 2022 trading, 2023, 2024, whenever you are at the 119, you always must remember, okay, this is the level that the market takes the profits out and they move it to whatever. Whenever you are at the 118.50, you must know, okay, this is buy levels, historical levels. That's why we gather information every single year that the market was trading at the 118, 119, 117, 120, same for everything else. That is called historical information, historical levels. There's no such a thing as, for example, gold trading with sellers, for example, at the 1800. The 1800 is being always a buy level, always. 1800 is not acting as the take profit. It's acting as the move forward prices, as they push more money here. That is called behavior of the market, and that accumulation over time, right? I mean, 5 years back, 10 years back, 15 years back, whenever the information we have from the broker, because we count only with the information we can gather from different platforms, historical levels. And that behavior, it repeats itself over time. Okay, so you go back, you put your charts into 1 day time frame or 1 month time frame, and you're gonna see the pattern. You're gonna see the pattern. So every time the market is at the 110 on the euro dollar, that divides the sellers or sell pressure to the buyers, the buy pressure. Every time the market is into and such. At first, it's kind of not that easy to see it, right? Because you're trying to count what candles am I going to use to know what, so you get a little bit confused. But over time, with practice and reading every chart every single time, the same chart, or with the practice, you're going to start knowing and understanding those levels for you. It's going to be and get easier. Okay, so again, this week, this is the first week of July, we are back into the strategy that we were managing with March. We're back to the levels of March. So it's like, if you're starting to trade now, it's like, doesn't matter what happened up to now, you're doing the same. You're going now 100% into the buyers on the euro, 100% into the buyers on the pound, dollar yen sellers, dollar Canadian sellers, because we are at the highs of March. So it means it's going to go down for the rest of the year. That's what it means. And I'm not saying that we have to sell now up to December. I'm saying that's what it means. We are back to the levels of March. So it's like nothing happened up to now. We are like zero. We started from zero. And that is a common thing. That is a common thing because we finished the corrections of the market, right? And that's what it means. So it's very important, right? Are we cool up to now? Are we okay? So, in terms of in terms of scalping, always remember that you want to use the opening hours, right? You want to use the opening hours. You want to use the London opening hour or the US opening hour, and it's up to you which one to go for. If you're on the eastern side, you rather go for the US opening hours, right? I mean, Europe, London hours, Africa, South Africa, whatever that side of the world is, you rather go for the European opening hours. Step number one, you have to decide what opening market you are going to use. Opening hours are the best. All the injection of the money, it happens on the first hour. All the injection of the money, it happens on the first hour. So you're gonna have up to 2 hours to get the best out of the market. That's it. Second suggestion, trade on 15-minute time frame. So you recognize if the first candlestick is on the first 15 minutes a sell candle, it means most likely we're gonna be selling for the next hour or 2 hours. Step number 3, consider the highest and the lowest. So if you got the first candlestick into sellers, right? The first candlestick is a sell candle on the market, and then you're gonna sell. Check the low level and the high level. Check what psychological prices you have around the market level that you are in, specifically at the opening. That might change everything. Example, you have the euro dollar, open the first candlestick, a sell candlestick, but then you have very close below it the 118.50. Guess what? It's a psychological price, the 118.50. What's going to happen there? The market is going to push into buyers. So even if open for sellers the first 15 minutes, probably you can have a bunch of buyers waiting for you right there, right below you, right below you. So it's not going to be enough interval for you to do anything. Again, check psychological prices first. Opening, time frame 15 minutes, first candlestick, buy candle, sell candle. First, was always better to see it, And so this is the exercise that I do. First, I see it. I see the possibilities. I see the possibility, because that is like if I already buying or if I'm already selling, like I visualize it first. I put it in my mind first, and then I see it. I stare at the supposedly trade that I'm doing. Once I'm very sure, 100% certain about it, then I jump and buy or sell. That exercise is going to help you. First, visualize the trade. If you buy, what will be the target? How much money you're gonna do on that trade? If you sell, what will be your target? How much money you're gonna make on that sale? Sometimes, because you are a little desperate at the opening, because the market is moving so fast and you don't wanna miss the first trades, you tend to jump right away. So be careful with the opening hours, because they are good, but also they are fast. And if you're the profile of anxious person and not really patient person, it's gonna play against you. And if you're that type of person and you don't work on that, then probably it's more convenient for you to trade after hours, to trade when the market is closed. I'm just saying, because if you're an anxious person and you're not doing anything with that, you don't meditate, it's gonna play against you. So make sure that you have your mind at the right place before you jump in the market, okay? And I've seen it happening. I've seen many traders being really good at price action, waking up at the right moment and waiting the right steps, confirmation, everything. But their personalities are kind of, anxious, and they come to me like, but I did everything right. And I'm saying, okay, what is everything right for you? Yeah, confirmation, buy price, sell price, right moment, and then I'm losing. And I can totally guess that that's because of anxiety. It can give you anxiety, right? You don't wait enough. You did not read the psychological levels around the market level that you're trading. You got stuck on a buy and the market pulled down. You didn't expire the trade, or you're hedging right away because you're desperate that it's going against you. Many things can happen. If you don't have the mind right in the place that you should, it can get difficult. And honestly, this is the easiest way to trade the market, is price action, and people lose because they're not patient, they don't wait enough, they take a loss when they shouldn't, they don't wait when they shouldn't, they don't wait the confirmation when they shouldn't, they jump in the market when they're supposed to wait the confirmation. Well, those things, those are the main reasons why people lose in this market. Not because this is difficult, not because you don't understand price action, not because pivot, not because you're broker. Well, depends. You have to be you have to be with a regulated broker. Don't invest on not regulated broker, please. It's not gonna help you. Not price action. You must go serious. Okay. Regulations always. You don't want the broker to just give you any price or any execution or whatever. You need to make it right, and if you have the wrong broker, trust me, you can be an expert on this, but the broker always going to win. Always. Regulation. Alrighty? So I think this lesson, it was more to summarize what we saw up to now, because I want to start pivot points the next Monday. And so I talked about everything pretty much: market areas, prices, historicals, opening hours, confirmations, intervals, and I would like to go to pivot points next week, and we're gonna give it a lot of time to pivots, a lot of time. But remember, that is gonna help you, but it's not gonna do the thinking for you. It's a great tool. It's a magical tool if you know how to use it, but it's not gonna do the thinking. You do the thinking. You must read whenever the market is into market range. Keep your notes clear. If you have your notes, and that's actually a very nice exercise. Before you buy, before you sell, have a notepad. You know, I have my notepad here, and I write prices and prices and prices and prices and prices every time. So before you jump, write it down. That little process subconsciously is gonna help you to say, you see, I'm planning things. I'm planning, you know, I'm doing the homework. You know, I'm not just desperate, just buy and sell and do something, move my money because I have it. Take notes before you jump in the market. Take notes. What prices do I have close in the market level? The 118.50. What's the highest? The 119. What's the interval? 118.50 to 170. Be careful with the 118.50. If you're gonna get and buy at the 118.50 and it's pulling down, you close it. You know, because I hear many people, if they enter the market, they just want to hedge every single time. Many transactions are not to hedge, are not meant to be hedged. You have to expire them. You must cancel them, you know. So be careful with the concept of hedging. It's not something that you just can use because it's a hedge. Yeah, I'm gonna buy, and if it goes down, I'm gonna sell. I'm gonna sell. If it goes down, whatever, I'm gonna hedge. It's not like that. I mean, if you want to do it right, you can hedge whatever you want, but it can get stressful if you don't expire what is supposed to be expired, right? Again, in the month of March and June, July, I mean, we already passed the corrections of the market, so we shouldn't be in a difficult situation now. Like now we have more smooth trading up to December, right? But again, some trades you're gonna hedge, some trades you're not gonna hedge. That's it. So today's trading, for example, the only thing we did is to sell dollar Canadian, and it's into sellers anyway, so sellers are still in the market. And then what we did is that was it. We were gonna buy the euro. We bought, but then we canceled the second buy, which it was at 118.70 right here. Because I know it's gonna go up, but I decided to cancel because I wanted to have a better price. And that was it. You know, sometimes it's one trade, and sometimes two trades, sometimes three trades. And my Bitcoin just closed. My target was 34,000. I had to take profit there. I just checked, so it's closed. You know, so that's it. It's as simple as it gets. But ourselves wanted to make so difficult and complicated, and because you don't have a reference, and I understand that. You know, you don't know people that actually is making a good living with this. You don't know, you don't have a reference, you know, and I did not have a reference neither. I'm not coming from people that knew how to trade. I'm not coming from, you know, I didn't know anyone. I had to do it myself, and I had to believe it for myself that I could actually have a living out of this. But you know, you just gotta, you know, convince yourself this is the way, and this is how you want to do it, and you want to do it, and that's it. So now we had a huge community of traders doing this every single day. But I did that community. I put together people, you know, that saying, because it happened to me. I wanted to be surrounded with people that knew this business, that actually can count on and have a conversation about markets and stuff. So I said, well, there's no such a thing. So I'm going to put them together. I put the chart, the chat for all of them. You know, we have meetings, we have the social media, all traders with us, learners and also traders. So, because I know what it takes at first. You're all by yourself. I know anymore. Okay, so I'm gonna stop the recording here on the Instagram because I wanted to keep it short. and I'm gonna finish with you here right now. So I'm gonna cut it here. All right.